Welcome back to Am I Catching a Falling Knife? I'm your host, Dave, and on today's show, we're diving into a stock that's seen a bit of a tumble recently, Chipotle Mexican Grill, ticker CMG, making us wonder, is this a delicious opportunity for a savvy investor, or are we just reaching for a sharp blade that could cut us? So, what's the story here with Chipotle's recent dip? Well, the market is buzzing about their Q2 2025 earnings report, and honestly, it wasn't a pretty picture. They missed revenue estimates, and perhaps more critically, their comparable sales, that's sales at established restaurants, dropped a significant 4%. On top of that, they actually lowered their full-year guidance to just flat growth. Ouch! This is actually their second consecutive disappointing quarter, which has clearly led to that sharp stock price decline we just mentioned. But before we dig deeper into how these numbers shake out, let's remember who Chipotle is. CMG is the fast casual giant, renowned for its fresh, responsibly sourced burritos, bowls, quesadillas, tacos, and salads. They really emphasize their food with integrity mission. As of Q2 2025, they've got a massive footprint, operating over 3,800 restaurants globally, with a big strategic focus on expanding those Chipotle drive-thrus for digital order pickups. Essentially, all their revenue, 100% of it, comes from these restaurant operations, primarily in the U.S., which accounts for nearly 98% of their sales. They're typically a cash cow, with over $1.5 billion in free cash flow and, impressively, zero debt. Now, let's get into the numbers. So, how did we get to that earnings impact number? Let's break it down. First, that 4% drop in comparable sales is a very big deal. Think about it. That's the core engine of their revenue, their established restaurant base, showing a significant slowdown. Since 100% of their revenue comes from restaurant operations, this directly hits their top line where it counts. Second, this 4% comparable sales decline directly impacts their top-line performance. And here's the kicker. They lowered their full-year guidance to flat growth. This tells us that new restaurant openings, like those Chipotlanes, are simply not enough to fully offset the weakness in their existing stores. This creates a significant drag on overall revenue growth in the upcoming quarters. Third, Chipotle boasts an incredibly high gross margin, around 71%. That's fantastic when sales are growing. But in a business like restaurants, you have a substantial fixed cost base, things like rent or a core team of staff, that don't change much even if sales go down. So, when revenue drops due to reduced comparable sales, you get what we call negative operating leverage. What does negative operating leverage mean? Simply put, a given percentage drop in revenue will result in a disproportionately larger percentage drop in operating income and consequently net earnings. Based on that 4% decline in comparable sales and factoring in this implied operating deleverage, we're estimating that earnings could be impacted approximately 2.5 times more than the revenue decline itself. So, if we take that 4% effective revenue drag from comparable sales and multiply it by our estimated 2.5 times operating leverage factor, we're looking at a projected 10% earnings decline. But wait, there's more. This is Chipotle's second consecutive disappointing quarter, and the market reacted very sharply. Considering this, we're projecting a slightly higher impact of an 11% decline on their upcoming quarterly earnings. It's not just a stumble, it's looking like a bit of a trend. All right, so with that sobering earnings outlook, what does it mean for Chipotle's fair value? To get a handle on this, I ran a discounted cash flow, or DCF model. For our assumptions, we used an expected 5-year earnings growth rate of about 14.6%, which is still pretty healthy, a discount rate of 9.5% to factor in the time value and risk, and a terminal growth rate of 2.5% for the long term. With those base assumptions, our model suggests a base case fair value of approximately $27.26 per share. However, when we factor in that 11% earnings decline driven by our narrative analysis, the picture changes quite a bit. Our narrative-adjusted fair value drops to about $23.71 per share. That's a significant difference, highlighting the impact of these recent performance issues. So, if you're looking at this as a potential long-term opportunity, where might you consider stepping in? Based on our analysis, some potential custom buy levels to consider, if the stock continues its slide and aligns with a more attractive risk-reward profile, would be around $35, $25, and $18. Remember, these are levels reflecting our view of where the downside might become compelling. So, to wrap things up on CMG, this is where I remind you folks that everything we've discussed today is for informational and entertainment purposes only. This is not financial advice. Investing involves risks, and you should always do your own thorough research and consult with a financial professional before making any investment decisions. Thanks for tuning in to Am I Catching a Falling Knife? I'm Dave, and I'll catch you next time.